Hi, good evening, students. Myself, Priya Gupta. I'm a chartered accountant and a company secretary, and I'm also a CPA. So I believe you must have gone through some previous sessions of law. And today I'm going to make you walk through the topic declaration and payment of dividend. So let us first try to understand why dividend is distributed by the companies. So basically, what happens is that the various shareholders or various stakeholders invest money in the company. And when they invest that money in the company, the company uses that money to produce returns, to earn profit. So when they earn profit, the shareholders or the stakeholders who have invested in the company wants proportionate return from the particular profit. So that's how the picture of dividend comes into place. So what we are going to understand in this chapter or the topic is what are the legal provisions for the declaration and payment of dividend, the conditions which need to be fulfilled before declaring dividend out of the reserves. Okay, so manner in which unpaid and unclaimed dividend is to be dealt, the nature and framework of the investor protection, investor education and protection fund, and the consequences of the failure if the dividend is not distributed or it is not distributed as per the Companies Act, or what are the provisions of the dividend declaration and payment. So basically, how the dividend comes into place, why the dividend is to be distributed, what does dividend encompass in itself, is it compulsory to make the transfer of reserves, is it necessary to have certain amount of reserves in place before I go about declaring the dividend. Then also understanding that who can declare a dividend, and if somebody is declaring dividend in the organization or in the company, who has to finally approve that dividend, and whether that dividend can be over and above the dividend suggested. That is basically the board of directors will suggest, the board will suggest a certain amount, and that has to be agreed upon by the shareholders in their AGM. So this is what we are going to cover in this chapter. So this, we can have a bird eye view by looking at this chart. Dividend, meaning of dividend, which we'll cover in section 235. What are the different types of dividend? We'll also understand that what are the various type of shares and how the dividend is paid on those different categories of shares. Dividend, declaration of dividend, what are the rules with regards to declaration of the dividend, means like what is the bare minimum resources that has to be in place within the organization before they can go about distributing the dividend. Then we have current year profit and we have past year profits, and what is the minimum norm which the law places into picture before we utilize the previous year's resources also for disbursement of distribution of dividend. Now, what happens if the shareholder does not claim the dividend? So what will happen to the unpaid or the unclaimed dividend? That provisions we are going to understand. And then we'll understand what is investor education and protection fund, how it can be established, and what are the various utilization for which this credit can be done for. Now, lastly, we will understand what are the punishments for failure to distribute dividend within 30 days. That is, if within 30 days, the dividend which is not distributed or claimed is not parked in the way the law or the provisions are stated in this particular category, what are the consequences, on what are the punishments which a person can be have to avail that punishment in particular law, and who can be exempt, or what are the categories that can be exempt from that particular punishment or fines which are put in place. Now let us understand the meaning of dividend. So basically, the company's law very straightforward says that the dividend means and includes interim dividend. So it does not define what is dividend as such, but it only elaborates, or it only extends the scope of dividend. So section 2, subsection 35 of the Companies Act 2013, which deals with dividend, only enlarges scope the dividend by adding interim dividend also. Interim, as the name suggests, means something in between. So when between the final dividend and the year starting, some dividend is declared in between that period, that is supposed to be called as interim dividend. And dividend in this particular section which we are talking about will include that interim dividend also. So what does that mean? That whatever provisions which apply, whatever punishments which apply to the final dividend category will also apply for the interim dividend category. Dividend is conceived as shareholders' return on equity or capital. So as I stated earlier in the beginning of the session, that the shareholders infuses money in particular organization or company with a vision that the company will utilize these funds to generate profit. Now, when the profit is generated, the shareholders will expect a return on the equity which has been put in, or the capital which they have put in, which is in the form of, one such form is dividend. It is distribution of profits, that is a portion of profit earned and allocated and as payable to the shareholders whenever declared. So basically, this pictorial presentation says it all. So it says that company profits in the form of dividends paid per share owned, and the shareholders expect and gets those returned in form of the dividends per share. Now, what are the prerequisites of the dividend declaration? So basically, the company in general meeting may declare dividends, but no dividend shall exceed the amount recommended by the board. So let us try to elaborate this. Okay. It says that we will not have no dividend. The company in general meeting may declare dividend, but no dividend shall exceed the amount recommended by the board. So, which means that if the board has declared certain amount of the dividend, even the shareholders in their general meeting cannot exceed that amount. Further, the dividend is recommended by board of directors in the board report. So basically, who recommends the dividend? It is the directors of the company who will recommend this dividend. And however, the dividend must be approved. The dividend must be approved by the shareholders in the annual general meeting. Then dividend is not a liability unless it has been declared by the shareholders, number one, and in a validly constituted annual general meeting. So number 2 point, which is important to note here, is it has to be validly constituted general meeting. Means if there is any general meeting wherein the constitution has not been proper, or it does not satisfy the requirements of the Companies Act, then it will not be a proper general meeting, and even if that dividend is approved in such kind of annual general meeting, it will not be supposed to be approved properly in the annual general meeting. Also, only an ordinary resolution is required and at the rates recommended by the board, or it could be such lower rate as they may decide. So here, if we suppose say that the board has recommended say 5% of dividend, but in annual general meeting the shareholders recommend 6% of dividend, it is not possible to do so. Vice versa is possible, that in case the shareholders or members say that they will recommend the board of directors recommend that a dividend of 6% is to be given and they reduce it to 5%, that is possible. So this clause stated here says the same, that the shareholders dividend will become liability only when it is declared by the shareholders at a validly constituted general meeting, passing an ordinary resolution, rates recommended by board, or such lower rate as may be decided. Declaration, this is really important, declaration of dividend by the company at a rate higher than the rate recommended by the board is not permitted. So if they recommend 6% and earlier it was 5% as was proposed by the board, it will not be possible. Okay. So prerequisites of dividend. So the company in general meeting may declare dividend, but no dividend shall exceed the amount recommended, as we have already read that. Dividend is recommended by board of directors in board's report, approved by shareholders, not a liability till declared by the shareholders in a validly constituted general meeting, and recommended by a rate which is either equal to what is board suggested or at a rate lower than they may have decided. Now let's understand this question. It says that AB Limited has issued equity having face value of 10 per share. Let's put it over there. It will be easy for us to do the question part. Okay, so it says AB Limited has issued equity share having face value of 10 per share. The shares are currently quoted in NSE at 250. So this is the basically market value, we can say. The company at its AGM on 27/7/20 has declared a dividend of 20%. Mr. Shekhar owns 1,000 shares, which he purchased at 300 per share. What is the amount of dividend? So this information is actually not needed because this is the market value. Okay. Sorry, we are not concerned with this. Similarly, what he purchased at, this is also not we are concerned with. What we are concerned with is what is the face value of the share. The face value of the share is 10. So he has 1,000 shares. So we'll say 1,000 shares, and the face value of each share is 10, and the rate of dividend which has been declared here is 20%. So this will be my share, my dividend which will be received. So that will come to your 2,000 rupees. Okay. The second question says that the shareholder at an annual general meeting unanimously passed a resolution for payment of dividend at a rate higher than the rate that is recommended by the directors. Discuss the validity of the resolution. So as we have already discussed this thing, that in case board has made a recommendation of a particular rate, the shareholders in the annual general meeting cannot make it at a rate higher. So basically not even all the board, even if all the shareholders agree on that, still they cannot recommend a rate which is higher than that. So let's see here, which is explanation of the question. So it says the articles of association, companies usually contain provision with regard to declaration of dividend on the pattern of regulations. This under regulation 80, the power to declare a dividend vests with the general meeting, but not even all the shareholders have the power to declare a dividend exceeding the amount recommended by the board of directors. So basically, now let us try to understand what are the different types of dividend depending upon the time. So as we said that there is a final dividend, and the definition of dividend encompasses or elaborates that final dividend also includes the interim dividend. Now, what is interim dividend? Which is in between the two periods. So let's see at in form of bird eye view what is difference between interim dividend and the final dividend. So definition wise, what does interim dividend says? It says it is declared and paid by an account during an accounting year before the finalization of accounts of the year. So let us now again try to do it over there in our board, which will help us have a better. Okay. So we'll explain point by point here. Okay. Interim dividend is declared and paid during an accounting year before the finalization of the account. So basically during the accounting year, which is paid as interim dividend. Final dividend is the dividend recommended by the board of directors and approved by the shareholders at the annual general meeting after the close of the financial year. So this is within the year, and this is at the close of the financial year. Announcement, it is announced by the board of the directors. It is recommended by the board of the directors and approved by the shareholders. Time of declaration, it is declared before the preparation of the statement of financial statements or statements of accounts. After preparation of financial statements. So this is basically before preparing your financials, and this is after preparation of your financial statement. It can be revoked with the consent of all the shareholders. It cannot be revoked. Final dividend cannot be revoked. It is declared only when the articles specifically permit the declaration. So articles have to permit this thing, your interim dividend. It does not require any specific provisions in the article. So this is major differences between the two of them. Let us see. So now this basically shows what are the requirements of the interim dividend. It is declared by the board before the closure of the financial year till the holding of the annual general meeting. Declared from surplus in the profit and loss account of the financial year in which the dividend is sought to be declared. So if we are talking about say financial year 22 and 23, so it will use the profit and loss of the year 22-23 till the point that the dividend is declared. Till that point, the profit, whatever has been earned by the company. Financial year in which the dividend is sought to be declared, profits of the financial year till the quarter preceding the date of the dividend declaration. So if dividend is declared in particular month, so we will consider the profit till the quarter preceding the date. So if, for example, a dividend is declared in the month of, say, October, so we will consider the quarter April, May, June, July, August, September. We'll consider the quarter preceding the dividend date of dividend declaration. We will take the profit till that point of time. It is ratified in the ensuing AGM by the member. So whatever declaration of interim dividend will be made, it will be ratified in the annual general meeting by the members. Now, what will happen if the dividend is declared and the profits are not adequate? So if the company has lost during the current year or by the end of the quarter immediately preceding the date of declaration of interim dividend, such interim dividend shall not be declared at the rate higher than the average rate of immediately preceding 3 financial years. So if in particular financial year, the company has incurred loss, it is not having profit. So then in that case, what will be done? It will use the rate which declared at the rate which is not higher than the average rate for the preceding 3 years. So if I'm talking about the financial year 22-23, if I'm declaring interim dividend for 22-23, and I need to declare the dividend, the rate with which I'm declaring the dividend should not exceed the rate which is preceding before that financial year. For 3 financial year, we will take the average. So we will go backwards. We will calculate from 21-22, 20-21, and 19-20. For these 3 years, whatever the rate of dividend was, we will use the average rate, and the rate with which I am declaring the interim dividend for that particular financial year should not exceed that average rate. So that's what they are trying to say, that such interim dividend shall not be declared at a rate higher than the average rate of dividend declared by the company during the immediately preceding 3 financial years. The amount of dividend, including interim dividend, shall be deposited in a separate account maintained with a scheduled bank within 5 days from the date of declaration. So immediately the dividend is declared, the company needs to deposit that amount of dividend that has been declared in a scheduled bank, and that has to be within 5 days from the date of declaration. So date of declaration is counted to count the 5 days for the purpose of depositing the dividend in the particular scheduled bank for the purpose of this dividend. So final dividend, what does final dividend says? It says then when the dividend is declared in the annual general meeting of the company, it is known as final dividend. The rate of dividend recommended by board cannot be increased by the members. So we have already discussed this earlier, and it has been reiterated here. Now let us understand, as I said, that we will also be understanding what are the different types or the natures of the shares. So basically we have 2 categories. One is preference shares and one is equity shares. Sorry. So I hope you have either understood this in your earlier sessions of accounts or probably in law, companies law, that there are different types of shares which are issued by the company depending upon the nature and the category. They have the different nomenclatures. They have different rights. They have different liabilities attached to the categories. Now, if I talk about preference shares and equity shares, so preference shares, as the name suggests, has preference over the equity shares or other categories in terms of their payment of capital, in terms of payment of their dividend. Now, again, preference shares is categorized into 2 forms. It is cumulative preference shares and there is non-cumulative preference shares. Again, the name says or explains it all. It says cumulative means that what gets accumulated year by year or over a period of time, right? So if suppose I have a certain amount of dividend that has been declared and due to inadequacy of profits, the company does not pay dividend for that particular year, it will get accumulated, and it will go on getting accumulated till at the point that the reserves suffice the amount of disbursement. So if I make a particular declaration of dividend for preference share, then it will keep on getting accumulated till it is finally disbursed, unless otherwise has been mentioned in those category of shares. Non-cumulative means that if during a year the disbursement is to be made, and if the profits are adequate, they get a preference of payment of dividend. If the profits are not sufficient, then it is not declared. Okay. Or in fact, they are not paid. Declaration has been made, but the profits were not adequate, so they were not paid. Equity shareholders are the shareholders who gets right once the preference shareholders are being paid for, whether it's dividend, whether it's capital. Now, this pictorial presentation shares what other classification based on the nature of shares. So shares have preference shares and equity shares category. Cumulative, non-cumulative, dividend accumulates unless it is paid in full. Non-cumulative shares, no arrears of dividend in future is payable. Equity, it can dividend dependent on dividend policy and the availability of profits after satisfying the right of preference shares. So preference shareholders will get preference over equity shareholders, and they will be paid only once this disbursement has been done. Preference shareholders, according to Section 43 of the Companies Act 2013, shareholders holding preference shareholders are assured of a preferential dividend at a fixed rate during the life of the company. Preference dividend, unless otherwise agreed, is non-cumulative in nature and need not be paid in any year where there is deficiency of profits. So, as we explained earlier, that non-cumulative nature means they need not be paid in any year if there is a deficiency of profit. Classification of preference shares on the basis of payment of dividend is as follows. Cumulative preference shares means that dividend gets accumulated, and any arrears of such dividend arising due to insufficiency of profits will be carried forward to the next year. So profits during the current year is payable from the profits earned in the later years. It gets accumulated, it gets carried forward to the next year. Next year profits are sufficient, they will be paid. In case still there is deficiency, again it will be carried forward unless they are paid in full. Until and unless dividend on cumulative preference shares is paid in full, including arrears, if any, no dividend is payable on equity shares. Non-cumulative preference shares, dividend is payable only in the year of profit. In case no dividend is declared in a year due to any reason, the right to receive such dividend for that year expires, and the holder of such share is not entitled to be paid arrears of the dividend out of future years. So, as I've explained you before, that non-cumulative means if there is a sufficiency of profit for that particular year, it shall be paid and disbursed to the shareholders, preference shareholders. In case there is no such sufficiency with regards to profit, it shall be not carried forward, it will expire, and the next year dividend will be taken care out of the profits of the next year. Equity shareholders, they are the shareholders which are not preference shareholders. It means that they will not enjoy any preferential right in the matter of payment of dividend or payment of capital. The rate of dividend on equity share is recommended by the board of directors and may vary from year to year. So basically, preference shareholders, when they are issued, they are already categorized that this much of the dividend rate is associated to that category. But for the rate of dividend of equity shareholders, the board of directors shall fix or recommend the amount of dividend that needs to be paid, and that this may again vary from year to year basis. The rate of dividend depends upon the dividend policy and the availability of profit after satisfying the rights of the preference shareholders. So preference shareholders will get preference with respect to equity shareholders. Provisions regarding declaration and payment of dividend. So here comes the play of section 123, subsection 1, which says that what are the sources of declaration of dividend that can be utilized during any financial year for the payment of the dividend. Now, before we try to understand what all categories can be used, we need to understand that what are the, how actually we need to come to the profit that is to be utilized for the current year for the purpose of dividend declaration. So there are various reserves which are created out of, maybe capital appreciation, maybe notional profits. They may be associated with respect to certain categories for which those reserves have been created, maybe for employees, maybe for some assets. They are not free reserves. So for the purpose of dividend, we can only and only utilize the free reserves. Again, when we are using the current year profits, we need to take care that the depreciation has been taken into account. Why are we emphasizing this fact that depreciation has to be taken care of before utilizing those reserves? What would happen? So first we need to understand what is depreciation. Depreciation is a kind of provisioning which we are making against fixed asset because my asset is being used or run in the organization to produce profits, to produce results. So it will keep on running. So if I talk about plant and machinery in case of manufacturing concern, which is of the main capex amount. If I talk about my furniture and fixtures, which is again the second important point of your fixed assets, we utilize this to generate results. Now, when the results are declared or profits are generated, at the same time, my machinery is also getting depleted. Normal wear tear is there. With the flux of time, the machinery is getting depreciated. Now, what would happen that if in my books I have put a an asset of value 450 CR, right? But when my company gets liquidated, or even if it's not getting liquidated, I need to exchange the asset because it has already been worn out, and I need a new asset to produce my goods. When I go in the market, it will not. Do you think it will be sold at 450 crores? No, it will not be. Maybe its value is just 100 CR, not even. It's 100 CR if it is of longer duration, for which it has been utilized. So the reason for making any provision for any asset is against any asset is that that asset will not be realized in market after efflux of time at the same value at which it is appearing in the books of accounts. Maybe some of you would have gone through, or maybe in future you will go through impairment of assets. Again, we kind of analyze whether the books value which is appearing and the market value which is appearing, or what is the return that asset can give. We compare and we kind of do the impairment of the assets. So why are we doing this? We are trying to see the sanctity of our books, see the sanctity of our goods, see the sanctity of the profits. That is it the correct actual profit which is reflected in my books of accounts, and actually are they the free reserves which we are talking about actually free or usable in format or not? So that's the reason we provide for depreciation. That's the reason we say that profit for the current financial year has to be taken before providing for the depreciation as per the schedule. Again, we are mentioning here that it has to be in accordance with the schedule too. It's not that the company decided one fine day that, okay, I'll charge 40% of depreciation on particular asset, and the next day it decides, no, 40% is not adequate, I'll go in for 25%. It has to be as per the rules and schedules that has been provided for in the section. Profits of any previous financial year or years. Profit of any previous financial years arrived after providing for depreciation in accordance with Schedule 2 and remaining undistributed, that is credit balance in profit and loss account and free reserves. It is to be noted that only free reserves and no other reserves are to be used for declaration or payment of dividend. So that's what I was talking about, that the free reserves can only be utilized. We in further sections will come about understanding that what does free reserves mean. We'll deal into this into much deeper details. C, both A and B. So profits of the current year after depreciation, profits of the previous year after depreciation, are providing for all the losses, making all the adjustments which are required for profit calculation, coming to a point that which is free for the disbursement, as it is not associated to particular asset for which it has been created. Provision of money by the government. So money may be provided by the central government or state government for the payment of dividend by the company in the pursuance of a guarantee given by the government. It could be that the company in which the area in which it is running is being supported, is being financed, or it may be, some kind of government guarantee has been given that, okay, some kind of subsidy is being provided, or grants are given, government grants are given. So in that case, if that amount is being provided by the government, then that amount can also be utilized for the purpose of disbursement of dividend, subject that amount of grant has been given, if certain conditions has been associated with those grants. At the same time, those conditions are also met, or those conditions are also fulfilled before we make those disbursements. What is the meaning of free reserves? So here we come, we will understand what is the meaning of free reserves. Section 2, subsection 43 defines the terms free reserves to mean such reserves which, as per the latest audited balance sheet of the company, are available for distribution as dividend. However, the following items shall not be treated as free reserves. So any amount representing unrealized gain, notional gains, or revaluation of assets, whether shown as a reserve or otherwise. So the nomenclature can change. We could represent it in any format in our books of account. That doesn't matter. But if it is unrealized gain, unrealized means the gains which have actually not been incurred. If there has been any revaluation of asset that has happened, that can be reversed also. So today, if suppose I feel that, as per the valuation given by the chartered accountant or maybe some company, that the value of the assets have gone up by certain amounts, we book that revaluation of assets in a book. But maybe that at some point in the later period, we feel that, or maybe we have been provided that the amount has gone down because of the valuation which is present in the market, then this revaluation will go down. So that is not basically free reserves. That is not basically available for disbursement. So that's how we come to say that we have to use the free reserves. Now, this can be unrealized, this cannot be unrealized gain, this cannot be notional gain, this cannot be revaluation of assets, this cannot be provisioning of depreciation, which is present in the book, which is associated to particular asset. Any change in carrying amount of asset or a liability recognized in equity, including surplus in profit and loss on the measurement of asset or liability at fair value. Similarly, if there is any change in carrying amount of an asset or liability which has been brought about and recognized, then that is also not treated as free reserves. Now, what are the points we need to keep in mind for calculating free profits for dividend? So there are 3 points that has been mentioned. First is that before declaring any dividend, carried over previous losses and depreciation not provided in previous years or years are required to be set off against profit of the company for the current year. In computing profits, any amount representing unrealized gains, notional gains, or revaluation of assets, and any change in carrying amount of asset or liability on measurement of asset or liability at fair value shall be excluded. So that's what we discussed, that if depreciation has not been provided for, or there is any losses, previous losses which have been carried forward, that will be first set off, that will be first knocked off before taking into profit for calculation of, for utilization of dividend payment. In computing profits, any amount which is unrealized gain, which is notional gain, or which is revaluation of assets, and any change in carrying amount of asset or liability shall also be excluded. Capital profits are not seen as distributable profits because they are not earned in the normal course of business and therefore normally not available for distribution as dividend. So basically, again, the capital revaluations or capital profits that have been booked on the sale of particular assets which are being taken out of the books, they are capital profits. So what are capital profits? The capital assets which are being sold off, which are being disposed of. If any profit is earned on them, that is capital profit, that is capital reserve, that is taken into capital profits domain, and it is not available for the purpose of distribution, normal distribution as normal profits. Why depreciation need to be provided for? So this is what we have discussed earlier also. Let's go into, delve into a little more detail why depreciation needs to be provided for. So let's, before you know, we kind of get a picture of what depreciation means, again, I would explain how things work. So in our books of accounts, what we do is, let me go to the whiteboard and try to explain this way. Okay. So what we do in our balance sheet is we have assets. At the same time, in profit and loss account, what we do is we keep on making a provision for depreciation. Now, this depreciation, what we do is we represent by deducting the depreciation from the assets. So basically, this will be represented as WDV, written down value of the asset, so that when this particular asset needs to be disposed, parallelly we have a provision that has been created from my books of accounts, and I can utilize this provision for making another new asset. Now, what would happen that in case I have not provided for this depreciation, I will keep showing my asset at book value, or basically at cost at which I have purchased it, plus additions which could be, you know, maybe cost of bringing the asset into use or some other things which are capitalized. We will keep showing them in this way in our books of accounts. And when finally we have to sell that asset, I will not be having any reserves in my books to knock off that loss. Because if my book value was 45 CRs and I go in the market, I may not be fetching 5 CRs. Maybe if 5 CRs, I'm at loss at 40 CR. Now, where will I knock this 40 CR? Because I don't have any reserves against it. I am not having any profit against it. So that's the reason why we create the reserves, so that we are able to knock it off. So depreciation is basically is a notional estimate of the reduction in the value of the asset due to wear and tear, due to effects of time. So even if I use I bring an asset into picture and put it in my factory, and I'm not using that, even the flux of time will make that depreciation of the asset happen, because the value of that asset will not remain same over a period of time. Improvements in technology, etc. Depreciation. So what does improvements in technology mean? So I think so in today's date, we all are using technical gadgets. We all are using technical equipment. Now, the phone which you are using gets depleted in terms of the technology in every maybe 6 months. So you are seeing models, whether it's iPhone. I'm not, merchandising any particular brand, but you may be using iPhone. You may be using maybe a Samsung, or you may be using any phone right now, maybe Vivo, and the technology just goes on changing so fast that maybe within 6 months you will have another model. So what is happening? Even if you have not used your phone so often, you have not used your phone with so much of utilization in terms of applications on that handset, still with the flux of time, with the technological developments, uh, disruptions happens in technologies, and it goes obsolete. So the value will not fetch in the market. Today, if you buy a car and you want to sell it the next day, that you will not get the same price with which you have purchased it. Same way with your handsets. So what is happening? It is not even having a flux of time happening. It is not even the wear and tear. It's about the improvements in technology. It's about, you bought something, and tomorrow if you want to sell it, you will not get the same value. If depreciation is not provided for, there will be two consequences. And what are those consequences? One, the asset will be overstated in balance sheet, and the profits of the current year will be overstated, because I'm not making provision, so my profits are overstated. I'm not reducing my assets, so my assets are overstated. In a company, in case a company declares all the profits earned during a year, during any year as dividend at the time of winding off, or not even winding off, I would say that even if the company has to sell the asset and bring a new asset into picture, then also the company will not have sufficient resources to repay the capital, to repay and bring about new asset, or in case of liquidation, it will not have sufficient amount to pay off the capital of the shareholders, but the actual realizable value which will be there will be not sufficient to pay off the expenses of winding up in case of winding. This is because the company has failed to retain the amount of wear and tear in the value of the asset by way of provision of depreciation. In a way, the company would have declared dividend out of the capital, which is prohibited. Hence, the law mandates provision of depreciation out of the profits before declaration of dividend. So this is little bit talking about depreciation, why it is needed, and how we have to take care while taking or utilizing the resources before declaration of dividend. So at this point, we will take around 5 to 7 minutes of break, and we will resume with some probably numericals. We'll try to use the numericals to explain and elaborate the concepts which we have done, and then take it forward from there. So we'll go in for a break for 5 minutes, and it's like 6:50. We'll try to resume by 6:55. Okay, so students, as we were discussing before about how and why depreciation is to be taken into account before we calculate the free reserves available for dividend, let us consider one example. Okay, now Shreyas Mechanics Limited owns a plot of land which was purchased long time back. As the property rates are going up, it decided to revalue. So there is a plot of land and it is getting appreciated. And this property is owned by Shreyas. Okay. Now Shreyas has decided to revalue this at fair market value. And this value is, which is moderately 10 times the original price, is going to go to 10 times. Okay. Now it says that thus resulting a revaluation profit of 20 lakhs. So, revaluation profit of 20 lakhs. Okay. Now, the board of directors is keen to utilize this 20 lakhs along with the free reserves of 24 lakhs for the declaration. So, what is the reserves which are already available? 24 lakhs. Now, what is board suggesting? Board is suggesting to utilize this 24 lakhs and 20 lakhs. So it is proposing to utilize an amount of 44 lakhs for the purpose of declaration of dividend. Okay. So at the forthcoming annual general meeting to be held on 28th September 2019, but according to provision, this amount of 20 lakhs cannot be utilized. So this revaluation of asset, this revaluation profit cannot be utilized for the purpose of dividend. This amount is not available for the purpose of dividend, right? So this amount cannot be utilized and we will have only reserves of 24 lakhs for the purpose of declaration of dividend. Now, it says that, but according to the provision of 123(1), the amount of 20 lakhs cannot be considered as it does not form part of the free reserves, as the same cannot be utilized towards the declaration of the dividend. So basically, this is what is reiterated, what we have discussed earlier, that the amount which we have free for the purpose of declaration of dividend will not include any revaluation amount, will not include any capital profit, will not include any profit from which the dividend, from which the depreciation has not been deducted. If any loss is accumulated, we will first set off those losses and then we will go about distribution of dividend from that particular profit. So this is what we have discussed right now. Transfer. Now let us come to the next category, which is transfer to reserve. Now there is, at times it could be that there is certain transfer which is made mandatory as per any law which is prevalent for that particular company, or it could be that there is some parallel provisions which are running for the for that particular company, because it is running its functions in those particular area. But for the purpose of dividend, it has been clarified that there is no compulsion for the purpose of transfer of reserve. So even if the company decides that it will not transfer any amount in the reserve, it can go about doing so. The profits of So it says the transfer of profits to reserve for any financial year has been left at the discretion of the company. Therefore, company is free to transfer any portion of its profit to reserves as it may deem fit. It may also decide not to transfer any of the reserves. Now, let us consider an example. It says that for the current year, Amla Watches, the company's name is Amla Watches, Alma Watches, sorry, Alma Watches, has for any financial year has been left to the discretion of the company. Okay, so whether they want to make any transfer or not is the discretion of the company. Therefore, company is free to transfer any amount. So for the current year, Alma Watches Limited proposes to transfer more than 10% of its profit to the reserves before declaration of dividend at the rate 12%. Can it do so? So it is proposing to make a transfer of 10% of its profit to the reserves before declaration of dividend at the rate of 12%. It is asking the question, can we do so? Yes. So Alma Watches is free to transfer any amount which it wants, including not transferring amount at all. So this is basically that provision for transfer of to your reserves or general reserves or free reserves, that whether they want to make any transfer or whether they do not want to make any transfer or they have any specific amount that can be transferred, they are free to do that. Now, the next question says that Briggs Shipyards is has earned a profit of 1,000 crores. For financial year 2018 and 19. It has proposed a dividend of 8.7. Now they are proposing a dividend of 8.75%. However, it does not intend to transfer any amount to the reserves out of the profit. Can it do so? Can they do so? Yes. Answer is yes, because the dividend declaration and payment section says that all the provision relating to transfer of reserves says that they can decide upon transferring any amount, including no transfer to reserve. Okay. Okay, so now we come to declaration of dividend when there is inadequacy or absence of profits. So basically, we are saying that the profits availability is inadequate. What is to be done in such cases? Okay. When there are no adequate profits for declaring dividend, the company may declare dividend out of profit of previous year. So first and foremost, we will check for the current year profit. We will see whether there are any accumulated losses. We will set off those. We will see whether depreciation has been charged or not. We will provide for depreciation, and if the profit is inadequate, we will use the profit for the previous years. Now for previous years also, there has been conditions which have been put for the purpose of understanding, for the purpose of utilizing the reserves which are pertaining to earlier years. Now, what does it say? It says that free reserves. Okay, we have understood what is free reserves. It says meeting such reserves which, as per audited balance sheet of a company, are available for distribution of dividend. Okay, the following shall not be treated as free reserves. So this we have already done earlier. Again, we will reiterate that it should not be unrealized gain when we are using these reserves of the previous years. Also, it should not be unrealized gains. It should not be notional gains. And it should not be revaluation of assets. So when we are utilizing these reserves, we have to be careful that these are not the things which have been added in those reserves. Under Rule 3, such declaration shall be subject to the following conditions. So there has been certain conditions that have been laid while we are using those reserves of the previous years. And what is the condition? Condition number 1 says, it says that the rate of dividend declared shall not exceed the average rate at which the dividend was declared in the immediately preceding previous years. So if I'm declaring dividend of 21-22 and I have inadequate profit, what does this mean? It means I cannot issue at a rate which is greater than the average rate of the previous years. And which are the previous year? We'll count backwards. We will go 2021, 19, 20, and 18, 19. If suppose this was 2, if this was suppose 5, if this was it was say 7. So we will come to, let us make it 8 so that it is divisible figure. So 15%. So average rate will come out about 5%. So the dividend that can be declared should not be more than 5%. So it says that the rate of dividend declared shall not exceed the average of the rates at which dividend was declared by the company in the immediately preceding previous year. And the conclusion is this, that rate of dividend that can be declared in case of inadequacy is equal to, is less than or equal to R1, R2 plus R3 divided by 3. Okay. Where RD1, RD2, RD3 are, or maybe here I've used R1, R2, R3, are the rates at which dividend was declared by the company in the immediately. When we say immediately means 21, immediately 21, the year preceding 21-22 will be 2021. Then preceding 19-20 and then preceding 18-19. So these 3 years we'll consider for the purpose of considering the rate that we have to calculate for the average rate, and the rate of dividend which we will utilize should be less than or equal to R1 plus R2 plus R3 divided by 3. That is the average rate for 3 years immediately preceding. However, there is a condition. If the company has not declared dividend in immediately 3 preceding financial year, then this condition is not applicable. Because if the company has not declared the dividend in 3 years previous to it, then it will not have average of this condition applicable to it. Now we come to condition number 2. What is condition number 2? It says that the total amount drawn from such accumulated profits shall not exceed 10% of its paid up capital. What does it say? It says the total amount drawn from such accumulated profit shall not exceed. That means should be less than equal to 10% of the paid up capital and reserves ten percent of the paid up capital plus free reserves. Appearing in the latest audited balance sheet statement. So this has to be as per the latest audited balance sheet. Okay. In other words, they have used the summary which I've said, total amount that can be drawn from the accumulated profits should be 10% of the paid up capital and free reserves as per the latest audited balance sheet. The amounts are drawn shall first be utilized to set off the losses incurred in the financial year in which dividend is declared, and thereafter any dividend respective equity share shall be declared. So this, again, whatever we are utilizing will first be utilized to set off the losses, if any, that is existent, and in the financial year in which dividend is declared, and thereafter any dividend is declared. So if suppose I'm using reserves and declaring dividend for 22-23 period, and there are certain losses which exist into it. So the maximum amount we will calculate from this formula, and whatever amount will come, we will first set off the losses and then we will declare a dividend. So this is all about condition number 2, which has been stated. Now we come to condition number 3. What does it says? It says the balance of reserves. So first हमने क्या किया? First we have calibrated how much amount of what is the percentage of rate that can be disbursed, that we calculated by calculating average. Now inadequacy is there, so we will figure out how much of the resources I can utilize of the previous year for the purpose of declaration of the dividend. So that we use by using the formula that 10% of the paid up capital and the free reserves as per the latest audited balance sheet that I will use, and that I can utilize for the purpose of declaration of dividend, provided I set off my losses first. Now, after calculating the reserves, we need to calculate that the balance of reserves which are now going to be left in my account should not be less than basically the 15% of the paid up capital after declaration of the dividend. So it says that the balance of reserves after such withdrawal shall not fall below 15% of the paid up share capital as appearing in the latest balance sheet. So what is the formula we can conclude for condition number 3? It says that whatever is the amount of free reserves that are left free reserves minus amount drawn for payment. This should not be, this should be greater than equal to 15% of my paid up capital as per my latest audited balance sheet. So this is another third condition that has been laid in case of inadequacy of reserves or surplus for the purpose of payment of dividend. So now let us take some examples and calculate and understand these provisions that has been discussed right now. So first question says, okay, one thing before we go in for numericals, it says that it is to be noted that all these three conditions are to be satisfied. It is not that one of these conditions are okay to be satisfied and then they can go about, declaring of the dividend. But all these three conditions are mandatory. Now, also it says that the conditions prescribed by Rule 3 are not applicable to a government company. Government company is a company in which either the stake is of the central government or the state government, or of the central government and one or more of the state governments. So this rule shall not be applicable for a government company. Now let us take example. So it says that Capricorn Industries has a paid up capital of INR 200 lakhs and accumulated reserves of INR 240 lakhs. Okay. Now, loss for the year 31st March 2020 is INR 30 lakhs. Dividend was declared at the following rates for the 3 previous years. Year 1, year 2, and here 3. What is the minimum rate at which company can declare dividend for the current year? So we will take an average 9 plus 10 plus 12. That comes to your that comes to 10.3. So any amount equal to or less than 10.3 is admissible. Therefore, the rate of dividend shall not exceed 10.3%. 10.3% of paid up capital, that is 200 lakhs. So what was my paid up capital here? My paid up capital was 200. So this is my rate. So I will apply to it to 10.3% of 200. That comes to 20.66 lakhs. Okay. This is the amount. Now we will come to second condition. What is the second condition which has to be satisfied? Let's calculate that. Second condition says that whatever resources we are utilizing should be, sorry, it says that the paid up capital and the free reserves which are available as per the latest audited balance sheet, we can utilize 10% of it. So we have a total of here, assuming that this is as per the latest audited balance sheet, this is 440 lakhs. So condition 2 says 440 ka we will take 10%. So that comes to 44 lakhs that can be utilized. Now out of this, what is there is that we have a loss. Where have I written the loss? There was loss of 30 lakhs. So 30 lakhs will be first adjusted from this. So we are left with 14 lakhs that can be utilized. And so we see that accumulated reserves
So hence the quantum of dividend will be restricted to 14 lakhs. Although as per the rate, it was coming as 20.66, but this will be restricted to 14 lakhs. Now we come to condition 3. Condition 3 says that my accumulated reserves left after declaration of the dividend. So my accumulated reserves are 240 and I declared the dividend as at 14. So my accumulated reserves that will be left will be 240 minus 14, that will be only 226. So this is more than 15% of my paid up capital. What is my paid up capital? My paid up capital was 200. So 200% ka 15% if I calculate, it will come to 30 lakhs. Okay. Sorry, 30 lakhs. So which is much above 30 lakhs. So this is more than 30 lakhs. So my third condition is satisfied. And so I can utilize and go about declaring 14 lakhs as my dividend. So when I declare 14 lakhs as my dividend, what is the rate? We'll calculate 14 lakhs divided by 200 into 100. That comes to 7%. That is my dividend. Okay. So, so students, let us take a break of 5 minutes. We'll be back after 5 minutes, and then I'll take some more examples on this reserve portion. So it's 7:26 by my watch. We'll be back around 7:31, 32, right? So let's take a break.
Okay, so students, let us take one more example with regards to reserves. So it says that Shilpa Sugar Mills Limited has been regularly declaring dividend at the rate of 20%. So 20% of equity. Okay. For the past 3 years, this rate has been declared. However, the company has not made adequate profits during the current year ending on 31st March 2020. So they are saying for the year ending 31st March 2020, the profit was inadequate. So advise the company as to how to proceed in the matter if it declares the dividend at the rate of 20% in the year 1920 as per the provision. So first and foremost, the rate of dividend has to be average rate of the 3 years. So it has been since constantly declaring a dividend of 20%. So it cannot exceed the rate of dividend from more than 20%. So 20% is the minimum thing which they have to, is the maximum thing they can declare the dividend for. The other thing which they are saying is, the condition says is that the amount of utilization that will be done from the earlier resources, because it is having inadequate surplus, the paid up capital plus the free reserves, 10% of this can only be utilized after setting off of losses. Okay, so the free reserve shall, the amount to be drawn from free reserve should not be, shall not exceed 10% of the paid up capital and free reserves as per the latest audited balance sheet. So this fact has to be remembered very consistently, that it has to be as per the latest audited balance sheet. Okay. The calculations made by the accountants or financial controllers or auditors, in between the period will not be considered. It has to be as per the latest audited balance sheet. The last point which is to be considered is that the amounts drawn shall be first utilized, obviously, as I mentioned, after setting off of the losses. And last is that whatever withdrawal we are doing, after that withdrawal, the amount that is left is 10% of the paid up capital as per the latest audited balance sheet. So these are the three conditions that is to be fulfilled while we are doing the dividend declaration in case of inadequacies of profits. So let us now just go through the PowerPoint presentation, which has been made on the lines of these provisions. So we discussed about transfer to reserves. We discussed these numericals. Now we were having this points which we were discussing right now. It says that where in any year there are no adequate profits for declaring dividend, the company may declare dividend out of the profits of the previous years transferred by it to the free reserves only in accordance to the procedures laid down in Rule 3 of the company's Declaration and Payment of Dividend Rules 2014.
The condition 1 says that the rate of the dividend declared shall not exceed the average rates at which dividend was declared by the company in the immediately preceding 3 previous years. So I'm reinforcing this fact that it has to be immediately preceding previous 3 years. So it cannot be that, any 3 years is considered. We have to consider immediately preceding 3 years. Now, rate of dividend has to be less than or equal to R1, R2, R3, and the average rate of these years will be considered. Sorry. And where RD1, RD2, RD3 are the rates at which dividend was declared by the company immediately preceding 3 previous years. However, this condition shall not apply if the company has not declared any dividend in each of the preceding 3 previous years. So, in case the dividend was not declared in any of the previous years, then this condition will not become applicable. Now, condition 2 was that the amount drawn from such accumulated profits shall not exceed 10% of the paid up capital and free reserves as is appearing in the latest audited financial statement. In other words, the total reserves that can be drawn from accumulated profits has to be less than equal to 10% of the paid up capital and free reserves. The amounts so drawn shall first be utilized to what? To set off the losses that have been incurred in that financial year in which dividend is declared, and only thereafter any dividend in respect of equity shares shall be declared. And now the condition 3, it says that after considering the dividend declaration, after utilizing the reserves for dividend declaration and payment, what balance is left as free reserves in the reserve account should not be less than 15% of the paid up capital. So the balance of the reserves which is left after withdrawal shall not fall below 15% of its paid up share capital as appearing in the latest audited financial statement. So free reserves minus amount drawn from the payment of dividend should be greater than equal to 15% of the paid up of the share capital. This is to be again as per the latest audited balance sheet. Figures have to be as per the latest audited balance sheet. It may be noted that all the above 3 conditions have to be satisfied cumulatively. It is not in isolation that one of the conditions is satisfied and the company can go ahead and declare the dividend. The conditions prescribed by Rule 3 are not applicable to government company, in which the entire paid up capital is owned either by the central government or by the state government or in collaboration of state government and central government. So this will become one second. Let me just make. So this is basically state government. Sorry about that. Okay. So these are the 3 conditions that are applicable, and we have discussed these numericals as well. Okay, so we have discussed ship terminals also. Now we come to the amount, depositing of amount of dividend. So section 123(4) says that the amount of dividend, including interim dividend, shall be deposited in a separate account maintained by a scheduled bank. So it has to be into a separate account. Even if the company is having some bank accounts which are already opened for a different purpose, it shall open a separate bank account, and it has to be with a scheduled bank, which is in the list of the government or under the various act that is categorized as scheduled bank. And this has to be done within 5 days from the date of declaration of dividend. Okay, so in case the company fails to do that, then it will be liable for action for the category of default of not depositing the amount of dividend within the stipulated time. Now let us take an example. It says, let's consider it. Okay. It says that the authorized and paid up capital of Avantika Ayurvedic Products. The company name is Avantika. Okay, it has an authorized paid up capital. And the amount of authorized paid up capital is INR 50 lakhs. And how is this bifurcation being into place? This is 5 lakh shares of domain, 10 each. At the annual general meeting on 24th September 2019, the company declared a dividend of 2 per share. How much is the dividend declared? Okay. Okay, so the amount of dividend must be deposited in a scheduled bank by what date? So when is the declaration done? Declaration date is 24th September 2019, and the clause says it is to be deposited within 5 days. So 5 days come to 29 September 2019. It has to be deposited. Okay, now it says payment of dividend. So section 123(5) contains provision regarding payment of dividend. These are stated as below. Dividend shall be payable only to the registered shareholder or on his order to his banker. So now we come to the category of payment of dividend. Whom we'll make the payment? Either to the shareholder himself or on his instructions or order. It is made to the particular bank. Okay. Particular banker. That will be provided by the shareholder himself. Right. Now, a purchaser of share whose name is not entered in the register of member cannot claim payment of claim payment of dividend to him though he might have made full payment to the seller of shares. In this regard, we will later in this chapter see section 126, which provides the keeping of the dividend, etc., in abeyance pending a registration of transfer of shares, unless the register holders have authorized the company to pay dividend to the purchaser. Okay, so basically they mean to say is that the name of the shareholder has to appear in the register of members. So let us take a hypothetical example. So Mr. R has shares, 250 shares of the company, and he has sold those shares to Miss K. Okay. These shares have been sold. Now, this entry has not been done in the register of members. So who will get the dividend? Mr. R will get the dividend. So that is what they mean to say. A purchaser of share whose name is not entered in the register of members cannot claim the dividend to him, though he might have paid full payment to the seller of the shares. Till the point it is not entered into the register of members, it will not get the dividend, right? Okay. And even though he has made the full payment, even though all the conditions of sale has been satisfied, still he will not be eligible to get the dividend payment done to him. Now let us take an example. Okay. It says the directors of East West Limited proposed dividend. Sorry about that. So East West Limited proposed dividend at the rate 15% on equity share for the financial year. Okay. The company announced 28 September 2018, 28 September. September 2018 as recorded for payment of dividend. Now, the company was the dividend was approved in the annual general meeting on 30th September. Mr. Binoy was a holder of 2,000 shares. Mr. Binoy, 2,000 shares he is holding on 31st March 2018. Okay. But he has transferred those shares to Mr. Mohan on 18th June 2018. Who will be entitled to the dividend? Now, when is the dividend declared? Dividend is getting declared on in September, in month of September, and the transfer of share has been done in the month of June. So as per the records, and if the entry has been done in the register, Mr. Mohan will be eligible for or liable for getting the dividend disbursed to him. According to section 123, dividend shall be paid by a company only to a registered holder of such share. Record date is the date announced by the company for determining entitlement to the date. So the record date is the date announced by the company for determining the entitlement of the dividend. So when we say that this is the record date, right? 28 September 2018 is the record date given by the company. So whatever shares in whosoever name is appearing on 28th of September 2018 shall be considered as the real holder of the share, and he will be entitled to get the dividend payment done to him. So in this instance, on the date announced by the company as the record date, Mr. Mohan is registered holder, and his name is present in the register of members. That is, Mr. Binoy's name is not present. Therefore, the dividend will be paid to Mr. Mohan. Okay. Now, let us take one more example. With the board of directors of Som Mechanical Toys Limited proposed a dividend of 12%. So board is making a dividend of 12% proposal. Financial year is 1920. Okay, the same was approved in the annual general. So AGM approves it. The same was approved of the AGM held on 25th June 2020. Okay. Now, Mr. Nitin Jha was holding 1,000 shares. Mr. Nitin is holding 1,000 shares on 31st March 2020. But the same was transferred to him by him to Mr. Raj. So he transfers it to Mr. Raj, whose name was registered on 20th of April 2020. So 20th April 2020 it was registered in the register of member state who will get the entitlement. So 31st of March, Nitin was holding the shares. This share got transferred and was in name of Raj on 20th of April. And when is the board declaring the dividend? The board is declaring a dividend on 25th of June. So according to section 123 subsection 5, dividend shall be payable only to the registered holder of the shares or to his banker. Facts in the given case that Mr. Nitin Jha, the holder of shares, transferred his shares to Raj in whose name was registered on 20th April. Since Raj became the registered owner, so Mr. Raj is becoming the owner before the dividend declaration date. So he will be liable for getting the dividend. Since Mr. Raj becomes the registered shareholder before the declaration of the dividend in annual general meeting of the company held on 25th, 2020, he will be entitled for the dividend. Okay. In terms of section 51, a company may, if so authorized by the articles, pay dividend in proportion to the amount of paid up capital on each share. Now, this is important thing. Let's just dwell into it. It says, section 51. It says that we can make the company can make a proportionate payment of dividend provided it is provided in the articles. So if the articles permit, the company can pay the proportionate amount of proportional dividend to the amount paid on each share. Suppose a shareholder has paid only INR 5 rupees and the face value of the share is 10 rupees. Okay. Now he has, and the dividend has been declared as 5 per share. So basically, what is the ratio of the dividend? The ratio of dividend is half. So if he has paid 5 rupees, what will be the proportionate dividend? He will get half of 5, that is. It says that in this case, if the articles authorized by the article shall be justified in paying 2.5 per share. Okay, so just let us just try to recapitulate what we have studied so far and summarize. So before we summarize, let us just take 5 minutes of break and then we will be back. And then we will summarize whatever we have gone through in this session. So we'll take a 5 minutes of break. It's 8:03 and we will be back around 8:08. Till then, let's take a quick break.
Okay, so students, let us now recapitulate what we have studied in our session till now. So basically, we have tried to understand what are the various rules and regulations for dividend declaration and payment and non-compliance to doing so. We'll come to it in our next session. In this section, we have basically focused on what are the legal provisions for declaration and payment of dividend. So basically, we have gone through what are the different types of dividend on the basis of timing. So we understood we have interim dividend, we have final dividend. Difference between the two is the point of time, and the definition of dividend encompasses your interim dividend also. So whatever provisions are applicable for the final dividend, same are applicable for interim dividend also. Now, the rate of dividend which is proposed by the board, it cannot be in the AGM, the members cannot exceed that amount. They have to basically approve the amount, whatever is given or declared by the board of the directors. They cannot exceed that amount. So we have tried to understand the meaning of the dividend, which is basically extending the scope of dividend. We have studied the different types of dividend on the basis of timing. Interim dividend, which is in between the financial year, which is declared in between the financial year, and the final dividend, which is declared after the financials have been prepared. Declaration of dividend, what are the rules to it, how we can declare the dividend, what resources we can utilize for it, what are the free reserves. Free reserves will not include my capital profits, it will not include notional profits, it will not include revaluation reserves, it will not include something which is not free for distribution. Also, the reserves which we will utilize has to be necessarily after adjustment of all the losses. It has to be after adjustment of depreciation, providing for of depreciation. We also understood that providing for depreciation is really, really important, because if we do not provide depreciation during any financial year, and that asset, whether it is because of efflux of time, because of the technical developments which are happening, maybe because of the wear and tear, because the asset is being used by the company for producing products, for generating results, for generating profit, it gets worn out. So when the asset is getting worn out and we are not providing for depreciation, it is increasing assets on one side and it is increasing profit on another side. And in case the company needs to go in for winding up, the amount of profit which is reflected will not be a correct pictorial presentation of the financials. At the same time, the asset will not show the actual value that can be fetched in the market. So what will happen is the payment has to be done out of the capital, which is not a correct thing. Now, it also lays down what we have to do in case of there is inadequacy of profits, how we have to cater to it. Before that, it also deals with how we have to, what is the criterion for the purpose of transfer of reserves. So for the purpose of dividend, the provisions state that there is no fixed amount that needs to be transferred to the reserves. Even if the company decides not to transfer reserves, then also it can go ahead and declare the dividend, right? So let us see what we have discussed here. So basically, meaning, as we said, it is including the interim dividend, it is portion of profit. So whenever the shareholders infuse the amount into the company, they want a proportion to be paid out of the profits generated, and that is what is called as return on the amount infused. Company profits, dividend per share, shareholders get a portion of it.
Now, prerequisites of dividend, we have already discussed that it has to be recommended by board and it will be approved by annual general meeting, and it cannot be a rate recommended which is higher than what is proposed by board. And then we discussed difference between interim and final dividend. It is basically the timings, it is basically who announces, and it is basically who will approve it at the end, at what timing it will be approved. It is close of the financial year, it is before the finalization of the accounts of the year. We have studied that in all the provisions with respect to your final dividend is applicable for interim dividend also. So similarly, it has to utilize the profits for the year any profits before the quarter, till the quarter in which the dividend is declared is to be considered. So profit of the financial year till the quarter preceding the date of the dividend declaration will be considered, and if there is any shortfall, then we will consider in the probably in the same rules as we are considering for final dividend payment, and the average rate will be calculated. Okay, and it has to be submitted, deposited in a separate account maintained by the scheduled bank within 5 days of the declaration. Okay, so now there is also classification based on the nature of shares. The nature of shares could be your equity shares, it could be preference shares, and they can be cumulative and non-cumulative. Cumulative means the dividend will be carried forward year by year till the point it is totally paid. Non-cumulative means the dividend, if the surplus is not enough to pay the dividend for that particular year, and then it will get lapsed, and we will consider next year as a new year for the purpose of calculation. So this is what we discussed for preference shares and cumulative, non-cumulative. Then we consider equity shares. Then we consider provision regarding dividend. We studied that we have to provide for dividend. We have to provide for depreciation before declaration of dividend. Profits for previous financial year will be only considered once we have made the provision for depreciation, and if there are any losses, then that has to be adjusted. Meaning of free reserves, we understood. We said that there has to be not unrealized profits, unrealized gains, notional gains, revaluations, capital gains, any change in carrying amount of assets. All this will not be constituting the free reserves portion. Once to be noted while calculating free profits, we considered first, we will set off the losses, we will provide for the depreciation, we will not account for notional gains, we will not account for capital gains. Then we considered why depreciation is to be provided. We have already discussed that in detail. Transfer of reserves, we already discussed that if the company, it is solely on the discretion of the company. If the company decides not to transfer any amount in the reserves, it can go about doing that. If it decides to make a proportion of the amount to be transferred to the reserves, it is free to do that. Dividend declaration rules in case of inadequacy of profits. There are 3 conditions. First is that in case the company is deciding to pay off the dividends, the rate cannot exceed the average rate of the immediately preceding previous 3 years. So we will take into consideration backwards 3 previous years, calculate the average rate of these 3 previous years, and the rate of the declaration in case of inadequacy of profit cannot exceed this average rate. Condition 2 is to be that the amount of reserves which we are utilizing cannot exceed. So it has to be less than equal to 10% of the paid up capital and reserves as per the latest audited balance sheet. After adjustment of losses, that amount is free to be used for the purpose of dividend declaration. And third condition is when we utilize this amount of reserves for the purpose of dividend declaration, the amount which is left after dividend declaration should be greater than equal to 15% of the paid up capital as per the latest audited balance sheet. So this is all about what we have studied today. So I think so. We will conclude this session by doing this much of portion of your dividend and dividend declaration and payment. So I would request you all to please go through this content and try to revise the numericals examples which have been provided. Go through the rules and regulations. We will be uploading the content as well as your practicing questions in your portal very soon, so you can start accessing that also. And in case you have any queries, so probably Institute has already populated the link for raising your queries. We will be catering to your questions also over there. So I believe this session was fruitful for you and the basic concepts have been clarified. And in case you have any doubts, you can post it in the link which is shared to you. And we will be in next session trying to focus on what would happen if the rules of the payment declaration and payment of dividend is not complied with. What are the legal consequences of it? What are the punishments? What are the fines that can be levied under the Companies Act on that? And we'll also try to focus on what is the unpaid or unclaimed dividend account, UDA, that we call. We will also understand investor education and protection fund, how it is created, why it is created, what are the funding for that account, and what can that fund be used for. So the second session, which will be, I think so, happening on first, will be focusing on this piece. So I really thoroughly enjoyed sharing my content and my knowledge with respect to this piece of law with you all, and hope it was same with you also. And this session will help you in understanding these concepts. So on this note, I will sign off, and I will say thank you to everyone, and let us meet for our second session, where we will focus on the second and the final part of payment and dividend declaration. Thank you so much. Have a good evening.